Welcome everyone to episode 27 of the Sloth Investor podcast. I'm once again joined by my fellow co-host Jay and a special guest for this episode, Eric Balchunas. Eric is a senior ETF analyst at Bloomberg Intelligence, where he leads the ETF and passive fund research. He's also the author of The Bogle Effect, a book which we will be exploring in much more detail in this episode. Welcome Jay and welcome Eric. Eric, how are you?
I'm doing well. I was just in Australia last week, so I still got a little jet lag going on. It's a long trip, but I'm hanging in. I'm holding up.
I can tell you, as someone who's over in sort of that side of the world, in Hong Kong, going back to the sort of the Toronto area, that trip home is killer. Coming over this way is not so bad. Going home, it usually takes, I would say, probably a good 4, 5, 6, 7 days to recover.
Yeah, it's funny you say that because I had the same experience. When I flew over, I got on a plane at like 4 p.m. Friday, and then I was in a plane for like 24 hours, and it was totally night out the whole time because you're going the opposite way of the sun.
Yeah.
Or I guess you're going with the sun, but you're on the opposite end of the planet, and I could sleep easier. Going back, I was in the daytime the whole time, harder to sleep, and I also wanted to get home. I was a little more excited, and yeah, I'm with you on that. I think you're right.
Do you have like the sleepies at around 3 p.m., 4 p.m.?
Yeah, I get those anyway, though. Hard to tell whether that's
even
jet
without
lag
traveling.
or just me getting old.
Fantastic. Well, Eric, we're glad you joined us for this episode, and I am such a fan of this book, The Bogle Effect. It was a quick read for me. I normally take quite a few days, several weeks to get through a book, but this was a 2 or 3 day sitting. I thoroughly enjoyed it. And I'm such a fan of Jack Bogle. Regular listeners of the podcast will know that Jay and I are both fans of John C. Bogle, otherwise known as Jack Bogle, and I'm really looking forward to this discussion. So, Eric, I wanted to first of all touch upon the fact that you mentioned early on in the book that when you Google Jack Bogle, the search engine brings up American Investor. But you talk about the fact that this isn't good enough. It's not very satisfactory. Actually, in your opinion, you see, more of a combination of Steve Jobs and Martin Luther as being more appropriate. So, in your opinion, would you like to touch upon the reasons why you deem Jack Bogle to be simply, much, much more than an American Investor?
Yeah, because when people think of America, I mean, he was an American Investor. It's not totally wrong. It's just I know that a normal person, when they hear that, they think of a Warren Buffett or a Peter Lynch. They think of an active investor, somebody who was able to like outsmart the system and make a ton of money, right? This is not what Jack Bogle does. I will say, what he did was made everyone a better investor. But really, I think the two things that the reason I compare him to Steve Jobs and Martin Luther and why he's such a fascinating study is that he made the products. Just like Steve Jobs made the iPod, the iPhone, the iPad, and Steve Jobs also put stuff out that, like let's say in early days, and then he'd make it smaller, more memory, and cheaper. Every new model was able to sort of cannibalize itself and the old one a little, and in that way he revolutionized tech. And I think Bogle did that with introducing low-cost index funds. Obviously lowering the fees over the years and just building the product, which made managing a company, leading people, having a vision, like it is tough to do all that. And he did that. That's the practical side of Bogle. The Martin Luther is just this Bogleism that is spreading, which is beyond Vanguard or his funds even, because I was just at the quote Bogleheads conference and they have chapters. I mean, it's literally like a religion that is spreading across the globe. And I call it Bogleism. And a lot of them, they don't necessarily use Vanguard funds. Some people do. Some use Vanguard funds on Fidelity's platform. Some just use Fidelity's cheap funds or Schwab's cheap funds. But they're all cheap because of what Bogle did. So in a way, what he spread was low-cost investing, not a lot of trading, good behavior, sound tax work. Just that's sort of, I think, what he introduced. And just like Martin Luther was sort of a rebel within the church, I think Bogle was. I mean, he was constantly abrasive. Martin Luther stuck it right to the church in the church giving sermons, and he basically created the Protestant Reformation, and was preaching against indulgences of the church. And I think Bogle is very similar in that way. So again, his protest kind of against indulgences, which spawned a mini religion. I think that's why I would compare them to those two people. I thought about that a lot because those are names you don't want to throw around. I also wondered if I said Martin Luther, if people who weren't that steeped in history would think Martin Luther King Jr. So I had to, but I was like, no, I read up on Martin Luther, watched the documentary just to be sure, and I'm like, yeah, this is very Bogle guy.
That's fantastic. Yeah, I just love the idea of that kind of synergy of both of those two extremely profoundly influential figures. So yeah, I can definitely see the comparisons that you make there. And you mentioned in the book that Jack Bogle's investment philosophy was all about addition by subtraction. And the more and more I read about that, the more and more it deeply resonated with me. And when I thought about my context in life and other scenarios in the tech world and so on. So for our listeners, would you like to perhaps expand upon that? And I think, again, in terms of my first bedrock principle of simplicity, it really resonates with me ever so much. So if you could touch upon again that idea of addition by subtraction and how it connects to Jack Bogle.
Yeah, sure. So addition by subtraction was almost the title I gave the book. That's how big of a deal. When I locked into this concept, I said, that's Bogle's life work. When he entered the fund business, basically a mutual fund would charge you 1% management fee, and then the trading cost would be about 1%. So 2% between you and the market, right? Now, maybe you got lucky and that manager did well, but most of them don't. So we'll just say that's 2%. So what Bogle did is he got in there, and over 50 years, it took him a long time, he removed almost the entire 2%. So there's nothing in between you and the market. He also removed intermediaries. He set up Vanguard where he wouldn't use the broker system. So you had to kind of leave all that and come to Vanguard. So he eliminated the broker as well, although now people use advisors. It's not totally black and white, but let's just say he removed that. And by giving a cheap index fund, I think he also removed the human behavior element. I think it's way easier to behave and hang in there in the down markets when you have a cheap index fund because you feel like you have the best deal. And a good chart that he uses back to that 2%, and I thought this was a great way to sell indexing in the 70s and 80s when indexing sounds average, and also you're not paying brokers. So you have an uphill battle here to sell this concept. And I really studied how did he sell this to Americans who are all about number one, Top Gun, best of the best, right? Average is not what we want. It's not intuitive. One of those ways is to show a chart of the growth of $10,000 over 50 years. In one line is you getting 8% annually, and the other line is you getting 6% annually. And the 6% annually over 50 years, you end up with like, I don't know, it's like $160,000. But with the 8%, you get like $310,000, like basically double. Now you put more than 10,000 at the beginning, and you could see the amount of impact that has. The costs just mess with compounding, and compounding is the magic. Compounding is the secret sauce of investing. It's the magic, and the only way to benefit from it is to remove as much cost as possible and be patient. And I think that is ultimately what he did by taking all that up. And so I think index fund investors these days, they get their whole market exposure for like 3 or 4 basis points. There's no turnover cost, so it's a clean, frictionless exposure. They view that as their alpha. So I just think the addition by subtraction is alpha generation, because essentially and it's locked in alpha generation. It's not like I might do it this year and not the next year alpha. And I just think that's profound. And most people recognize it. And that's why in bear markets, you see index fund investors, especially Vanguard, takes in money like nothing's wrong. And I think that's because he provided that addition by subtraction, and that's the mindset those investors have. It's unusual. I don't think in historical times we've never seen investors this well behaved as the ones that are in Vanguard funds and other cheap beta type products.
You mentioned Vanguard quite a few times, and just for the purpose of our listeners who might not know what you mean, can you sum it up in 2 or 3 sentences? What is Vanguard when you make reference to them?
Yeah, and when I talk about how he removed the fees over time, this is an important point of my book, which is that Vanguard is a very unusually structured company. It's sort of owned by the funds, which means the investors basically own it ipso facto. So it's referred to as a mutually owned company, sort of like some insurance companies have this structure, but no asset managers do. It was born out of a really quirky situation because there's really no economic incentive to go to Wall Street and set up a firm where you hand over all the future profits to the people. That's just not how people think. That's just not how capitalism works. And so no one's copied it since. So it's pretty much the sole mutually owned company on Wall Street. And when you're mutually owned, at the beginning, if you get some assets, you get a little more profits. If you're an investor and you're represented on the board, you're going to vote for lower fees because that's what you want to spend those profits on because it benefits you. And so what they did is over the years they kept lowering the fees because that's what the board wanted to do with those profits. And so the first index fund was priced at 0.46%. So it wasn't like 3 basis points off the bat. It was 46 basis points a fee. But every year or two, they just lowered a fee, a basis point or two here and there. And so over 40 years, it went down to 3 basis points. And so that's why this low cost thing that Vanguard implemented is not a gimmick. It was done the hard, long way. And it's now a permanent thing. And I think that mutually ownership structure is the real change agent, combined with Bogle's unique structure. Those two things, in my opinion, set off the explosion that we're seeing. It completely changed the whole investing and Wall Street apparatus today. Indexing, ironically, gets way too much credit for the index fund revolution. It was lucky that Vanguard and Bogle were around and that structure existed. Because had it not, I think index funds would exist, but they'd be 80, 90 basis points, and they'd be on the fringes. They're only a huge hit sweeping the world because they're under 10 basis points. That's the thing. And they're only under 10 because of Vanguard structure, which, again, is sort of like a self-perpetuating fee-lowering thing, which happened over many years. And again, one of the reasons I was attracted to the book was I wondered why it had never been copied, because it was obviously so useful and works so well. And it's interesting, 50 years and no one copies this structure. It's a good question.
It's fascinating, isn't it? Fascinating. And something that struck me while reading the book was Jack Bogle's sense of humility. So, for example, you noted in the book how abnormal it seemed to be for someone of his status to be reached so easily. So would you perhaps be able to, for our audience, be able to kind of drill down a little bit more into Jack's sense of humility? There's a few more examples I can think of from the book, but could you kind of touch upon those as well for our audience?
Yeah, I mean, I think, one of the things that a couple things. Bogle was just very communicative. He would email you if he met you, he'd get to know you. Our first meeting was hour and a half. I was expecting 20 minutes. And then, he would trade emails a little bit. I mean, again, someone of his stature, you're just not expecting them to even consider a little person that big of a deal. And he could say, well, you're in the media. He wants to make basically build you up. But at that point, he didn't need that much extra media, although he did like working the press. He was very good at it. But he did it to other people. Like I was interviewing people who were part of the Bogle Princeton. Bogle had a scholarship fund for Princeton, and I was talking to kids who were benefits of it. And he would go and visit every year and talk to them, and then he would write them messages. And these were all emails and letters that were not meant for the light of day, and they all had the same stories, which he seemed to just take time to get to know them. That is huge. Again, that speaks to the humility that he's not bigger than just talking to a normal person. The other thing is, I think he was happy driving a Volvo, wearing the same khakis for 45 years. In a way, I thought he was cut from the same cloth as Buffett. It's a more World War II generation mindset. It's a thrifty mindset. He was not a boomer, and he was birthed out of the Great Depression, and so he knew what it was like to have nothing. And he was just around the World War II. He wasn't in the war, but he was of that era. And just like Buffett, I think these are just not flashy people, and these are people who are looking for other more satisfying ways to live life than having a ton of money. And I think that those were ways he was, I think, had some humility. That said, he had a big ego. I think one of the things I explore in the book was, I feel like Bogle was miscast almost in this industry. What drives a person to go to Wall Street typically is the fire in the belly. the idea that you want power and money. I mean, which is okay, some good things can come of that. Sometimes you can get totally corrupted too. Well, I'll let people use their imagination. But he had seemingly immunity to greed. Like he just wasn't a greedy guy. He didn't need a lot. And he wrote a book called Enough, which is about just enough. Really, it was almost a letter to corporate CEOs and to the whole capitalist institution. Like you can do capitalism, but you don't need to go crazy. You don't need a 10,000-foot yacht or whatever. Like you can just chill a little. Don't focus on quarterly earnings so much. Just everybody.
A Jerry Maguire moment.
Yeah, it was totally. That's a Jerry Maguire book right there. And then, but I said in the book he's not a they called him Saint Jack, but he wasn't like he was a human being, and humans have needs, and I think he could never get enough adulation. I think with his relationship with his father, I think he was trying to fill in being liked and appreciated, and he was always looking. And so when his son told me a story that they would go on vacation and he would run into like a doorman or somebody who would stop him and say, "Hey, Mr. Bogle, thank you so much. You helped." And he would hang out with that guy for like 30 minutes. And the family could never understand why that was such an important thing. And my deduction is that why he was immune to, and he had enough money, he could never get enough adulation, and he loved the St. Jack thing. And, that was the way he filled the void inside that we all have. So I think those would be some of my sort of points on humility. But like I said, I don't think he was totally humble. But I will say what I do think he had was character and discipline. And he was right down to the end, very protective of the small investor, which is pretty rare. I think a lot of people want to serve their investors, but it's always at conflict with them wanting to make a ton of money. And a lot of times you can't have both of those.
Yeah.
Did you met with him? Sorry.
Go ahead, Drake. Go ahead.
I'm curious. I think you had a total of 3 interviews with him. Is that right?
Yeah, we met 3 times in his office for interviews. And then he was on the TV show I did and the podcast I did. We exchanged some emails. Like I would see something in the press and shoot him an email. What do you think of this? And he'd write back. So I had a little bit more there. And I had interviewed several Vanguard people over the years. So that was sort of the foundation. But it was really those 3.5, 4 hours of just me in his office rapping with him and debating him. Every time I walked in, he was ready to go. He had papers all over his desk. As you know, I'm an ETF analyst, and he wasn't hot on ETFs. And so a lot of what we did was almost like 2 fund analysts just going at it. And I realized later why he was all into because he would go, "Do you see this fund that the ETF just launched? It's a whiskey fund." And I'm like, how does he even know about that? That's a tiny little ETF that launched that no one bought and it liquidated 2 years later. But this guy, this 87-year-old legend, is totally on it. He knows all the latest developments. And I realized because he was always writing books. So as he was writing books, he needed data information. He was always using, I think he used Morningstar a lot. And so he was in the data. And in a way, he's writing about funds. My job is to write about funds. So when we kind of connected, it was pretty equal. I mean, he had way more knowledge than I did, of course, and experience. But the stuff he was looking at was what I was looking at. And so that's what made the interviews so dense and interesting to me, rather than me just saying, what did you do in 1980? Why was Vanguard great? It was a clash. I would ask him about smart beta. I would ask him about sector ETFs. I would ask him about fees and taxes and, a lot of the things that we debate now. And so there was a lot of juice there that was relevant to today beyond just this guy started this company and, made things cheap. Again, the Bogle Effect is not just funds. It ripples out across the whole ecosystem. And that's what I wanted to capture here. And I think our interviews captured a lot of it.
Do you have a favorite memory with him? Is there something a particular time or a particular happening that sticks out in your mind?
Yeah, I mean, I would say, I'd say probably a good memory of him was the first meeting I had with him. I walked in and we had our interview, and he, by the end I was a little more relaxed. I was a little nervous going in, and I was relaxed. And he goes, "Hey, look, it's noon. You want to go to lunch over at the cafeteria?" So I said, "Sure." And so me, him and his assistant Mike Nolan, we walked over, and he was very old. He walked very slowly. We walked from his office, which was like across the courtyard, to the cafeteria. He obviously was working on Vanguard's campus, even though he wasn't CEO at the time. And he walked real slow, and everybody's walking by. Hi, Mr. Bogle. Hi, Mr. Bogle. And he's saying hi. He walks to the cafeteria, and he gets his food, plops right down in the middle. Like he's around all the junior people. He must have brought the average age down to about like 30, 32. You know what I mean? Like everybody was like young, and he didn't give a shit. I mean, there was no concern of people like bothering him or whether he should be in a special place. And then we sat there and had lunch, and we gossiped a little bit about, some people we knew. And I don't know, that was a nice moment where he could have got the lunch delivered to his office. Do you know what I mean? I feel like that's what I would do if I was, that legendary. I might just not want all the hassle of the people. And I thought that was pretty cool of him. And it's a memory that stuck out.
I think it kind of speaks against that sense of humility, that sense of being every man and kind of, not thinking you're above it, a certain degree of employee and so on. So, I remember, I think you mentioned that in a book. It was a delight to read that. And again, just speaks volumes about the man indeed. So, Eric, you spoke a little bit earlier on about kind of the behavioral aspect of index funds and just how advantageous it can be for people once they get into that style of investing. And this was new to me in terms of Michael Lewis. So Michael Lewis, of course, the author of The Big Short, he's quoted in the book, and he speaks about the fact that it really helps to free up people's time when they begin investing in index funds. It just enables you to spend your time with your family on leisure pursuits and so on. So would you be able to explore that a little bit further for people who really, are coming at this in kind of that beginner context?
Yeah, so this is a great point by Michael Lewis, and I use it in my PowerPoint presentation when sometimes I'm asked to speak on the book, and I have a 70-slide PowerPoint, and this is one of the slides because I think, first of all, it's Michael Lewis. People respect this guy, and Michael Lewis, I had read 7-8 years ago in a Market Watch interview that he was an index fund investor, and I think he even said he used Vanguard or something. So when I interviewed him, I asked him. I was always curious why he didn't cover this. This is, in my opinion, arguably the greatest story ever told on Wall Street, and he never covered it. I think for him, it just wasn't salacious enough. There wasn't enough of an arc. This is not like, maybe he thought it was too well known, but anyhow, regardless, as we were interviewing, I think he saw what I saw. I think he kind of got it. But when I asked him about his own investing, he said it just allowed him to not worry about it. I think, and this is part of why I think the flows are so consistent for passive funds, even when the market's up, down, sideways, is because people check out. And I think a lot of them wanted to check out. I think they just want to set it and forget it and not worry about it. There are people who like to twiddle, you twiddle the knobs and mess with things. And I think either those people might do indexing and then keep 15% for just going crazy and speculating, or indexing isn't for you. You really just want to really get into this and do investing your way and trade. There's nothing wrong with that. It's hard, but it's fine. I think for a good chunk of people, rather than worrying about okay, this manager I picked, he had a good run, she had a good run, and now it's down. Do I get out of it and get in the other fund? Usually I'm doing that at the wrong time. That whole process, a lot of people see futility in it. And they're like, I'd rather just not worry about it. And so when anybody can escape worrying and watching the market and just even caring, they take it. And I think Bogle allowed that portal out with the cheap index fund. And Michael Lewis, again, to credit how it helped him become a better writer is pretty massive, because he's obviously probably the top financial writer in America. And I thought that was a compelling way. And it took you into the mindset of what I call the great resignation that happens with index fund investors, where they just, and that's, I've used that because I'm constantly having to push back. It's a little less now, but there was a time when people were worried about passive investors, they were like the weak hands, and they were all going to run for the exits when the market got bad. They thought they're only hanging in now because the Fed's made easy money, everything's up. Wait till the market goes down. I was like, no, it's not going to work like that. They're actually going to keep putting money in. It's active mutual fund investors that are going to run for the exits. And I knew this because 2008 showed it, and there was other down markets where we studied it, and we're like, okay, I'm sure it's going to happen again, and it did. This year, passive has taken in about 500 billion, active seeing close to $1 trillion out. And so it's the diamond hands that these Robinhood people speak of. These investors have diamond hands, but it's not like they're even watching it. It's almost just they're just checked out. They've gone, I'm not going to do any better than this. I don't need to mess with it. And Bogle actually predicted this to an extent. He said when he created Vanguard, he realized he had an opportunity to create a new fund company his way. He said we have to make funds that are predictable and have predictable returns. So, but even if he had only active funds, Vanguard's active funds are pretty predictable. They're usually low turnover, low fee. They don't do anything crazy, and I think that predictability is even greater in index funds. And they are predictable. You know they're going to track the market. You don't have to like worry about that, and so you can mentally, go do your thing.
Fantastic, thank you, Eric. The Hedgehog and the Fox. Now, I will concede, this is a story that I was so unfamiliar with. And I think I've got a pretty good background. I've got kids myself, and I've read a fair bit in my past. But this is a story that was completely new and fresh to me. But I know it's a story that Jack Bogle was fond of. So would you be able to perhaps summarize the gist of the story and why it resonated so much for Jack Bogle?
Yeah, to summarize it quickly, it's basically the story of like the hold on a second. I got to recall it myself. It's been a while. I wrote I wrote that about a year ago. It's basically something where the fox is thinking all of these creative ways to try to outsmart the hedgehog, and the hedgehog simply just goes up and curls into a ball, and basically is able to elude getting eaten or become prey. And the idea, it's a basic, there's a little more to the story, but the basic premise is that the fox is very clever and knows all these clever things, but the hedgehog knows one great thing. Yeah. And that's all that the hedgehog needs. And so this also speaks to that, what we just talked about, which is that he thought the index fund investors were the hedgehogs of the investment world. And you've seen there's a whole area of the investing world where people have all these formulas. They think they've solved the puzzle. They're fascinated by all the data, and it's fun. I mean, people like it. It is fun. It's like trying to solve a puzzle that can really never quite be solved, and it really is fun for the brain to be active in that way and to look at the data and look at all the trends. I get it. I get why it's fun. It's just tough, and you can see why somebody comes along and they're able to drop all these fancy terms, speak in Greek symbols, and they impress you. And I see it on Twitter. Those people get a lot of clout. And then someone who's an index fund investor comes along and says, "Yeah, I just buy the S&P 500 index fund like every month, and that's all I do." Well, that's boring and it sounds simple, but over the course of 50 years, you know who will win that return battle, and likely, I guess. And that's sort of, I think, the point of the story. And what I think Bogle was trying to defend the index fund investors over the years. He also was trying to explain that it doesn't have, it's because it was looked at as simple and dull. And a lot of people think complexity is good and excitement is good. And he was always trying to sort of judo style turn that around and explain, no, this is actually cool. This stuff is good. And he just came up with all of these ways to do it in his books and in his speeches. And I think that story was one of those ways.
Be sloth-like, right?
Yeah, absolutely.
Yeah, definitely.
I'm looking at, could there be a rival in future weeks? The Hedgehog Investor. Let's look out on social media, guys. There may be a rival.
Hedgehog versus the sloth.
Exactly. Who would win? So, Eric, something that really impressed me when reading the book was the fact that you really became a Bogle scholar. I mean, your research was deep, it was wide, in great depth. And you mentioned, for example, a reference to the two masters problem, which Jack Bogle referred to in his book, Character Counts. I believe it's Character Counts. And again, this is something that is pretty interesting to me, and I know that many of our audience members may be unfamiliar with this problem of the two masters. So would we be able to touch upon it now for our audience, the two masters?
Yeah. So back to the mutual ownership structure. Um, when there's profits, when there's extra money at a fund company, there's two main ways they're structured. One is as privately owned, where that extra money tends to end up in the founder's account. So like the Johnson family of Fidelity have like, I don't know, 20, 30 billion net worth. Or in a publicly traded company, that money would go to the stockholders, like maybe a BlackRock, right? Or a T. Rowe Price. They would pass that on as dividends potentially. So those are two masters basically, and the obviously in each of those cases, the other master is trying to serve your investors. You're trying to serve the shareholders of the company and then the investors in the funds, and those two things kind of are at odds. The investors want revenue, the shareholders want revenue. That means the fees that puts in the fees on the investors, right? Makes sense. So that's why people say like, "Oh, what if Vanguard went public?" I'm like, dude, they would be the worst stock ever. Because there's no money. They make so little revenue. In fact, here's a stat that is mind blowing, and I found I kind of really highlighted this in chapter 1, is that Vanguard accounts for something like 27% of all U.S. fund assets, which, by the way, is double the high water mark of anyone else in history. Fidelity was like 14% in the 90s. Now Vanguard's 27, 28%, but they only count for 5% of the revenue of the industry. That gap is crazy. And so so in Vanguard's case, if there's extra profit, the people who are represented on the board represent the investors. And so they just want to use that money to help the investors. So that means you lower the fee. And so that's the one master versus two masters. Now in the book, I take great pains to explain that just because you serve two masters doesn't mean you're a bad person. But incentives matter. That's the takeaway. Incentives are very important in this world, and the mutual ownership structure just really helps the incentives. And I think people are like, people who work at Vanguard for a while were worried that they were not going to make any money, and so this idea of like, well, if all the money goes to the investors, what about the employees and the people who work there? And I try to remind people that you get paid fine there. The CEO is well paid. We don't know what he makes, but it's likely equivalent to other fund CEOs. But what there isn't is there's not a $25 billion family dynasty money. There's no Jeff Bezos money. That money is what went to the investors, right? But people can get paid fine there. But there's no massive lump sum that is owned by the shareholders or the founders.
Yeah, it's fascinating. Thanks for expanding upon that for us, Eric. So we mentioned The Big Short earlier, okay, Michael Lewis, and you mentioned the fact that he's such a great financial writer. You mentioned in a latter part of the Bogle Effect this whole concept of the big long, and the fact that more and more behavior advisors are kind of really embedding that philosophy of that mindset of the big long. I mean, many of our audience members may be unfamiliar with this concept of the big long. Would you be able to kind of explain that in a little bit more detail for our audience right now for us?
Yeah, sure. So you know how in The Big Short there was these like couple hedge fund guys who saw something before everybody else did, and they follow those people. And I feel like that inspired a whole generation of top callers, people who were like top. It like made it cool to like short and call tops, and I see it all over Twitter.
So you're just for our audience purpose, you're talking The Big Short, the movie, the book,
the book. Yeah. So, but what I noticed happening while all the people were trying to be cool by calling tops, there was a new trend forming with these advisors who are RIAs who are really looking at evidence. They tend to be paid as a percentage of assets as opposed to getting a kickback from the fund company. And so they're investing in a way that is like Vanguardian. I think they buy Vanguard funds or cheap beta funds. They keep it simple, they keep it cheap, and they work on like getting tax efficiency and do planning. Their value add is more in that. And so they are like Michael Lewis. They're like, instead of checking out to do other things, they just realize an advisor, I'm not going to get a better outcome for my client by messing with the portfolio. It's great. And so they just hang in there. And so every time there's a sell-off, or there's been so many news flow where it seems like the sky is falling. They don't sell. They just keep pumping money into these funds, and I call them the big long advisors because, in my opinion, reverse big short. These are a lot of them are younger too, and they have seen something that the top callers don't see, which is there's no reason to get out of here. The real pot at the end of the rainbow comes in patience. As Michael Batnick of Ritholtz put it, chasing patience. Instead of chasing performance, you're chasing patience. And to get to that Zen Buddha-like state is the new big short. And so I give them credit. And interestingly, they even, like, when there's a sell-off and the media goes crazy to try to get clicks, and normally that would cause a huge reaction and panic, but they don't care. In fact, they sometimes make fun of that whole panic, and that and they're able to sort of like really put the bad news in context, and they're able to stay the course, as Bogle would say. So I refer to all of these RIAs, which are growing and growing, as the big long advisors, because they're just long and they're not budging. And that's the sort of relentless bid that's going to come into the market for a long time.
I love that. I love that. The phrase "the big long" so deeply resonates with my philosophy as well, of course, being a Sloth investor. So Jack Bogle's legacy is undeniable. It really is undeniable. His profound influence upon the realm of investing. And I like to quote now from the book. This is absolutely one of my favorite quotes from the book. It comes from the latter stages of the book. This is you in one of the final chapters. His success wasn't in playing the game, but rather in changing the game for the better. I absolutely love that quote. So Eric, for any beginning investors viewing this video, what would be your advice if they wanted to adopt an approach to investing that is underpinned by Jack Bogle's approach to investing? What would be kind of your 2 or 3 top tips? What do you think?
I think a lot of it, you probably picked up in this interview, but I think what he ended up doing is he launched a bunch of like value funds, growth funds, but he ended up crapping on a lot of the stuff that even he launched, and he sort of arrived at this place of ultimate simplicity, which Rick Ferry calls the nirvana. You finally get to this. It's ironic because that simple place of nirvana that could take you years and decades to finally arrive at, you actually don't need to go through all that because it's so simple. And what he would probably advise is, depending on your age, is just buy and hold a total market index fund or an ETF. Some people pick the S&P 500, but you have to understand that's just large caps. Yeah. A total market would give you small, mid, and large. So either one of those two, and just make that like, he didn't even believe in international investing. So he was that pure. He would probably advise, and this is like, I think Bogle would probably agree with I call it the Buffett portfolio. One time someone asked Buffett, like, what should I, a regular investor, do? And he's like, don't do what I do. You need to, it's not for everybody. What I would do or advise you is what I am going to do with my whole net worth and my trust, and which I put in my will. I want all my money invested in an S&P 500 index fund, 90% of it, and 10% in short-term treasuries. And that's what he has instructed his will. And when I interviewed him for the book, I said, is that still true? He said, absolutely. And so that to me is probably the Bogle portfolio too. Again, if you're young, that just having that little buffer of treasuries can take a little of the sting off of a downturn and give you some cash, if you need cash. But just going long one index fund. Now, advisors the big long advisors, they may do 60% in the S&P, 30% in, say, the aggregate bond index, and then maybe 10% in maybe something that's important to you, like maybe real estate income funds or a dividend fund or something if you want yield, something like that. So it doesn't have to be that simple. Again, Bogle just arrived at a completely total simple place, similar to that Buffett advice. But if you did that, it'd be hard to, and Buffett said it, you will beat all the pros over time. And again, so if Buffett and Bogle kind of are at the same spot, it's hard not to take that very seriously. Those are two titans, and one is the most famous active investor and one's the most famous passive, right? And so it's ironic they kind of both arrive at the same advice for small investors. But again, that portfolio is 90% equity. So I would just almost say if you were older, some people would say, well, maybe you would make that 10% treasuries or the 90% equity. Maybe you'd put in maybe bonds in there more. That's the only thing I would caveat that with. But as a young person, that just seems like a pretty solid way to go. But I don't give investment advice. This is just me sort of like
Sure.
regurgitating where they both arrived. And this is over a long career, both of them. This is what they said in their 80s. So yeah, it's pretty simple. And it's funny how simple it is.
Yeah.
It's
Yeah.
ironic, right?
Yeah. I mean, I was reading a Bogle quote. I think it was from a conference several years ago. Perhaps it was maybe 2009 now, but I think he mentioned the phrase, simplicity is the master key to financial success. And it really is. In most realms of life, we think about perhaps, becoming a doctor or a dentist or many other professions. There's a great deal of complexity involved. But when it comes to investing, that's one of the fundamental paradoxes to me when it comes to a realm of investing. Simplicity outperforms complexity, and that's what has always fascinated me about investing. It really has. Jay, is there anything else you want to touch upon before we bring the discussion to a close?
Well, and I know that you say that you don't give investment advice. Is there any, for our listeners, any ETFs that you like?
Well, I like them all. I like covering this industry. It's a big tent. Like I said, it's from Vanguard to the VIX. ETFs cover everything, and I enjoy that. But I'm a pretty simple investor in my own personal account. We have a Schwab account, and we have some low-cost ETFs from Schwab. And then I have a 401k in which I just do similar low-cost kind of boring portfolio, although I have international. I'm not totally Boglean, totally. So I'm not, exactly like that. But I try to keep costs low. Now, my wife is a value type investor. Like she'll see like GE trading at like $20.
Okay.
And she'll be like, we should buy that. Like she's that kind of a Buffett type investor, like, and so sometimes we'll invest in a stock, or she will, that she sees low cost. But we haven't done that in a while. We've gone pretty boring. And so, yeah, that said, we write about ETFs all the time, and there's some that come out that are intriguing to me. Like, for example, 5 years ago, I was really intrigued by the uranium miner ETF, which is because I thought nuclear is going to have to be used to solve climate change. You can't just do it on solar, and that the world may come around to accepting nuclear as a way to have your cake and eat it too. And it's starting to happen, and that ETF went a nice run. So I had a good idea there. But I've had other times where there's psychedelic ETF come out that holds like ETFs that track stocks that like make psychedelic medicine, which is supposed to replace like Prozac and stuff, and even opioids. And I thought this is a solid fundamental idea, and that went down 70% since it launched. So, my ideas work. This is why it's hard. This is a hard thing to win all the time. But those ETFs and those stories, those themes can be interesting. And then some people try new ETFs where they only invest overnight, and I like covering all these ideas. I think it is interesting, but there's very few that would compel me to actually move my money over there. But like I said, I think the modern portfolio these days is 85% cheap beta, right? Boring, vanilla, low cost 60/40. But 15%, 10%, I can tell from the flows, people are looking for excitement, something exactly the opposite of the cheap beta. This is where an ARK, Cathie Wood type would fit. And I think people, or even opening a Robinhood account and doing stock trading, just something to scratch the itch. This is for the people who don't want to mentally check out or feel like they're going to have FOMO if they don't get their claws in some of these speculative investments. They want to think like, what if Cathie Wood's right and there's all these robo-taxis and I knew I could have invested in this future. I don't want to miss out. So you put 5% in that. That way you feel like you're participating, but it doesn't completely mess you up with your, the real money that matters. So I think we're finding this barbelling going on, which again, that's why Vanguard is so important for the middle. But these really novel, even wacky things, we take seriously and write about a lot because they sort of complement the boring. And so I think that's sort of where the fund industry is going to go. And those ETFs that are on the crazy hot sauce side, I find a lot of them pretty interesting. They all have come with these fundamental stories and these ideas attached to them. But it's very difficult. I was with Bogle once. I'll end with this. I was with Bogle, and again, I would make cases for all these different things, and he would just sort of like shoot these ideas out of the sky like a skeet shooter, one after another. And I remember saying to him, "Okay, how about this? Let's say I really think semiconductors are just so important to our society for the next 50 years, and there's only 2% semi or 1% semiconductor exposure in the S&P. Why not buy a semiconductor ETF? I'm diversified across a basket. Semis are a very solid story. It's not like psychedelics. What's wrong with that, right? Isn't it a logical take?" And he goes, well, he thought about it for a second. He goes, okay, well, look, if you're going to speculate, better to buy an index of a bunch of basket of stocks than to pick one. But if you're speculating, you're a damn fool. So he just, like, again, he might give you like a little bit of credit for your idea, but then he would just destroy it all after that. And so that was the sort of dance we did for hours. And so the case I just made to you, even though you just heard his response, you still can understand the semiconductor case, right? And this is part of where in the book, even when he would crap on people's, livelihoods and worlds, I think a lot of people were able to sort of compartmentalize his comments, like, oh, that's just Jack being Jack. So I put both out in the book. I don't totally reprimand people for buying a semiconductor ETF. I understand it. He wouldn't do it. And so I show both, I want to get the mix in there. But that's just how hardcore he was. But I think that semi case makes sense to me. And that's where I think that 10-15% hot sauce lane is where you'd put that. So you can go to sleep knowing I have a little stake in what I consider the biggest trend of the next 10 years, which is semiconductors, because they're needed for everything.
Yeah. And I like the fact you mentioned hot sauce there, because on quite a few occasions during a podcast so far, Jay and I have spoken about this term that I kind of devised of like an investment palette. When we go to a restaurant, we have our own unique palette. I love spicy food, for example. Mr. Sloth and the kids, not so much. And it's the same when it comes to the world of investment. You can go that hardcore approach of just, a pure S&P 500 index fund, or you can go for more of, I guess, that satellite approach. We've got, 10 to 15% in, other ETFs, if it's semiconductors or speculative investments. So yeah, I like the way you refer to it as kind of that hot sauce aspect as well, for sure. Eric, thank you so much for joining us. It's been a real pleasure. And to our audience members, I cannot recommend this book highly enough. It's well written, it's incisive, and it's evident that you became so much of a Bogle scholar in terms of putting it together. So it's a thoroughly enjoyable book, and I learned so much from it as well. I really did.
Eric, if people want to find our listeners want to find out more on you or hear more from you, how can they do so?
Yeah, so I work at Bloomberg, and my content, what I write, is on the Bloomberg terminal only. So unless you have a subscription, you probably aren't going to get it. But there's ways to get me for free. One of those ways is Twitter, at Eric Balchunas. We put charts on there all the time and give our takes. And then I have a podcast called Trillions, which you can get anywhere for free. And I have a TV show where I'm one of the co-hosts that's called ETF IQ, which is on Bloomberg TV every Monday at 1 p.m. Or you just Google ETF IQ, and all the old episodes are stored digitally. And those are, I would say, free ways to get me. And I would like to thank you for the compliment on the book. You clearly picked passages that were a little novel. Not all the interviewers picked stuff you did, and I could tell you were really, you had totally absorbed the book. And I appreciate that. I worked hard on it, and I did. I always say, when you write a book, you're going to go live on that planet for 2 years. And so I had to live on Planet Bogle. But I wanted to. I said, this is a good planet to live on. I can only benefit from hanging around here and discovering things. And I'm glad that came off.
Absolutely. Thank you so much, Eric. And Jay, thanks for joining us again. And it's been a really rich, productive discussion. Okay, that was episode 27, everyone. So long until the next time. Bye, everyone.
Thanks, guys.
Bye.